What a day. What a day. US CPI comes out hot. Stocks take it about as awfully as one might think. Red ink all over Wall Street. The US dollar surges. Bonds crack lower. Just about exactly what we talked about on this very air yesterday. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do today is look at next steps, and they take us outside of the US. One of the big movers that we saw today was, of course, the euro, which took a major leg lower against the dollar. And that has put it in a critical spot, just as the European Central Bank prepares to deliver its monetary policy announcement and tell everybody just how different from the Fed it is and how different of a situation the euro is in relative to the greenback. So we're going to look at what is about to happen here with the European Central Bank, what they're likely to do, why, what the variables look like, and then look at a trade setup in the euro and see how it might look to very practically, in a very hands-on way, actually trade this, because we are at a make or break spot in terms of where the euro sits at the moment. So, first things first. The ECB is not expected to change policy this go-round. So the deposit rate, as we can see here from ESTR futures, these are the benchmark interest rate futures for the ECB, the equivalent of what Fed funds futures are for the Fed. We can see here that for April, we're at 3.91. So we're only about 9 basis points off the benchmark deposit rate of 4%. So doesn't look like we have any reasonable probability that the market is assigning to seeing a change this time. By the time we get to June, we're down to 3.79, and of course, one cut would be 3.75. So what this works out to looking like is an 84% probability that in June there is a cut. That would, of course, line up very neatly with the rhetoric we've heard from the ECB for months now, which has kept saying, we need more data, we're not sure yet about inflation, we need more evidence, we think we're going to have the evidence by June. Well, the market thinks that the evidence stacks up such that in June they're going to almost certainly go. 84%, of course, a very commanding likelihood. We then see that come September, a second cut is fully baked in. That says, of course, two things. Number one, we can see in July, we're at 3.68. So it's not a question for the markets as to whether the ECB will cut in June. It's a question of whether it'll be June or July. But by September, we can already see that second cut is in the market. It would be down to 3.5 and it's down to 3.48. So we have fully discounted two cuts by September. By the time we get to December, we're at 3.17. So first, that's lower than 3.25. So we've fully discounted three cuts by year end. If we look at what that says about the likelihood of a fourth cut, since it is, of course, below 3.25, that comes up to about 32%. So we've baked in just a little bit less than half of that fourth cut. If we look at the overall structure here, we can see that at this point, the markets are baking in 74 basis points in easing. So again, three cuts are on the menu, and there's a slight chance of a fourth. Now, one element here is that, of course, when we got the move today from the Fed and what happened to those odds of policy change, we had spillover. This is because the Federal Reserve is not just the steward of U.S. monetary policy. It is by statute, of course, but because the US dollar is the quintessential unit of commercial exchange globally, a rise or fall in US borrowing costs and US interest rates means a rise or fall, usually, in global interest rates, because as we never tire of saying here on Macro Money, according to the latest data from the Bank of International Settlements, which is a kind of central bank for central banks, it's about 88% of global monetary transactions that are settled in US dollars. And so we have a situation where if it becomes more expensive to borrow dollars or less expensive to borrow dollars, since that is the quintessential vehicle for economic activity globally, it then becomes more or less expensive to borrow. Period. Anywhere. And so when we got the hot CPI number today and yields in the US jumped, they also jumped in the Eurozone. Not for any reason that might have to do with the ECB becoming more hawkish. There's absolutely nothing of the sort. Rather, it was that interest rates in the Eurozone followed the Treasury market's lead in the US. And so what we saw, you can see here, is a slight diminishing of the number of rate cuts that are being baked in for the ECB, but not for any ECB-related reasons. These are interest rate futures, and interest rates moved. And the reason that interest rates moved was because of a hot US CPI number moving the expectations for how many rate cuts the Fed is going to do. But that has knock-on effect. So, if we look at, comparatively speaking, what that looks like, the Fed is now barely expected to deliver 2 cuts. Never mind the 3 that they've been guesstimating in their forecasts. We settled in Fed funds futures to show that the Fed is going to cut by 34 basis points this year. That means 1 cut. And it also means that 16 basis points of a second one have been baked in. So the likelihood of a second cut is higher than even, 64%, but barely so. Needless to say, that was a very major, very large adjustment. We were looking at 57 basis points, 58 yesterday, and we've gone to 34. So we've moved more than 20 basis points here in a day. In fact, almost 24 basis points, almost a full rate cut's worth in a day. So, of course, that was going to have knock-on effects. What this means is that the likelihood for ECB stimulus probably has room to readjust back into the 80s, where you can see it's hovered for quite a while. Yesterday, before this CPI announcement, before the Fed outlook changed and muddied the waters, we were looking at 81 basis points baked in for the ECB, and not very long ago at all, it was more like 90. So there is room here for the ECB to set the stage for something more dovish than is already on the menu today. And they seem to have the ingredients to do it. The latest CPI data surprised on the downside, incidentally, as we expected here on Macro Money when we were talking about it ahead of the report. 2.4% year-on-year headline inflation versus 2.6% expected. And when we look at the makeup of that inflation, it seems like the case for continued and broadening disinflation is in place. Now, we don't have the components for the March figures yet. They haven't been released. The ECB has only released the preliminary view of that data. So we don't have those components. But if we look at the way it looked in February, we can see that food, which had been by far the biggest contributor to overall inflation all through 2023, has slipped into second place. That's this right here. It is still one of the biggest contributors to inflation, of course, but no longer the leader. And this follows something that we've been looking at for quite a while, which is the relationship between global food costs, because needless to say, the ECB can't do anything with interest rate policy to discourage people from eating. So they don't have much of a lever to pull. They don't have much agency there. It's really a function of what's going on global markets. And what we see here is that the United Nations measure of global food prices from the Food and Agriculture Organization within the United Nations, that's the blue line there, it tends to lead Eurozone CPI by about 7 months. So it takes about 7 months for changes in global food costs to filter into CPI. So you can see here that there is a tail of further disinflation waiting to make its way into CPI that hasn't yet. And so there's room for this to continue. Already we can see a significant step lower. This was an addition of 88 percentage points to headline CPI in January, and only 54 percentage points in only 54 basis points of the increase in February. So what that tells us is that this part of it probably is going the ECB's way. The other big component here is discretionary, hospitality, restaurants, and hotels. You would think this part of the story would be very sensitive to the economic cycle. So if there is economic weakness, you would think that would be what's likely to deflate that part of it. And indeed, we seem to have those ingredients as well. Here's the latest set of PMI numbers from the Eurozone. We can see it's narrowly returned to neutral after 8 months of contracting economic activity. As ever, this is in the logic of PMIs. So 50 is neutral, above 50 is growth, under 50 is contraction. The further you go above 50, the faster the growth. The further you go under 50, the faster the contraction. And what you see here is that manufacturing and the service sector are diverging. Manufacturing is growing, and the pace is quickening. Or services rather is growing, and the pace is quickening. Manufacturing is going the other way. It's shrinking. It's been shrinking, but the pace is over the recent months accelerating. So we're looking at a situation where, with those two things going in opposite directions, overall growth is basically pinned to neutral. But the recovery that we've seen here, going essentially back to about the middle of last year, may be running out of steam. Here is that recovery. This is the Eurozone Economic Surprise Index from Citigroup, and indeed we can see that from about the middle of last year, Eurozone economic data has been getting better relative to forecasts. Well, now it looks like it's stalled. So perhaps this is the extent of what there is to see on this recovery. Perhaps we can be pinned at neutral here and not make very much progress beyond that. It certainly does not look like the story here is of the economy rapidly accelerating. And so from that perspective, the disposable income linked discretionary spending sensitive hospitality sector is likely to feel the pain and is likely to have a disinflationary wave facing it going forward. All of which suggests that if we look at what's left here on the menu, this seems to be taking care of itself. This seems likely to move lower with the economic cycle. There's a hodgepodge of things in the miscellaneous category that's reasonably elevated compared to the rest, but otherwise, it looks like inflation is coming away. It looks like the Eurozone is in a place where they could, in earnest, begin cutting interest rates. Now, what that means, if we look at how this compares with most of the other major central banks, what we find is that it pins the ECB with the lowest peak in rates of all the majors. Now, the one central bank that we don't have here that is of particular interest is the Bank of Japan. It is not expected to cut interest rates at all this year. And so, of course, the yield differentials there are very much tilted against the euro, even though rates in the euro area are expected to land just a hair above 3% here, as we incidentally just saw in the futures. The markets care about the direction of travel. The actual absolute levels are priced in. And the direction of travel, if there is something to be undone in today's futures outlook for the ECB, because it was a knock-on from the Fed rather than anything domestic, and the dovish ECB has scope to change it, the direction of travel would be toward baking out more rate cuts for the ECB while the Bank of Japan stands still. So that, of course, is an interest rate differential moving against the euro. We clearly saw that today the outlook for the Fed jumped. That's that green wiggle that you see right there. That gives us a widening differential in the dollar's favor. And all the other major central banks stack in the middle and really point to this idea that of all these central banks, it will be the euro with the biggest yield disadvantage when all is said and done and the calendar turns to 2025. So, with that in mind, what does that mean for the euro? Well, clearly it got hosed earlier today. The decline here lining up down almost, actually, no, a full percentage point. It was jostling around there a little bit at the close, but ultimately we closed down 1% here, even just a bit over. And that actually amounts to the worst one-day performance for the euro since May 15th of last year. But much more important than single-day performance is where it has landed. You can see here there's a very clear, very well-defined support area right here from about 107.09 to 107.58. So about a 50 pip support zone right here off this low and along these lows here. And we are, of course, sitting squarely atop it. If the ECB is going to follow through with everything they've been saying for months and months and come out and say, right, we are going to have the evidence in June. We think it's likely that June is going to have a cut. The ECB, by the way, is a central bank that has used a pre-commitment before. So whereas the Fed wouldn't pre-commit, the ECB hasn't shied away from such things. So if the ECB comes out and says, right, we've been saying the same thing, we're not going to change our tune here, we think that the ingredients are there, we're probably looking to begin cutting. Then the euro might well push through this area. And if it manages to close, let's say somewhere around the 107 figure, but under this low, well, then we could be looking at a very significant decline to follow, because there really aren't very many touch points from here on the downside until you get back to last year's lows under the 105 figure. So we could be setting up here for a major downturn. As you can see here, obviously there was a trend higher. It got broken. We found this initial support. We came in for a retest, got rejected, and this is the moment of truth. This is where we start the next leg of the down move, if one is going to happen. It is on a break of the initial support that held once the up move was overturned. If we can make it through here, well, look out below. And that is macro money for today. As ever, we are here every single day on Mondays through Thursdays, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and how to interpret it and what it might mean going forward. I'm also on with Chris for Futures Power Hour on Fridays, on with Victor and Tom for First Call on Sundays, and actually on with Victor again today for his new show, The Price of Truth. That will no doubt get very macro and very nerdy very quickly, so do come and check that out. I'm also writing for the news and insights portion of tastylive.com and opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you tomorrow.